Ever wondered why index funds are often recommended by financial advisors? They've been growing in popularity, haven't they? You see them everywhere, from retirement plans to investment portfolios of seasoned investors. Despite their ubiquity, the workings of index funds remain a mystery to many. What makes them so special? Why do they often outperform other investment options? These are the questions that pique our curiosity. So let's not keep you in suspense any longer. Today, we'll unravel the mystery behind the success of index funds. So, you might ask, why should I choose index funds over other investment options? Well, let's take a moment to compare. With individual stocks, you're putting all your eggs in one basket. This can lead to high rewards if the company does well, but it also means high risk. Bonds, on the other hand, are generally safer, but they also offer lower returns. Mutual funds can be a mixed bag. They offer diversity, but they also come with higher fees, and the performance is heavily dependent on the fund manager. Now, enter index funds. They offer a unique blend of advantages. First off, they are low cost. Since they simply aim to mimic a particular market index, they don't require the same level of management as other options, which keeps costs down. This means more of your money goes towards your investment, not fees. Secondly, index funds provide diversity. They spread your investment across a wide array of companies, reducing the risk associated with investing in a single company. Lastly, while the returns may not be as high as betting on a single stock, they tend to be more consistent and less volatile. This is because they are designed to match the overall market performance rather than trying to beat it. Clearly, index funds have a unique blend of benefits that make them stand out in the investment world. But how exactly do these index funds make money? Well, to understand this, we first need to grasp what index funds are. Simply put, an index fund is a type of investment fund that tracks a specific market index. This could be a broad market index like the S&P 500 or a more specialized index focusing on a specific sector or region. By mirroring the performance of these indexes, index funds aim to replicate their returns. Now, let's break down the two primary ways index funds generate income: dividends and capital gains. Dividends are a portion of a company's earnings that are distributed to shareholders. When you invest in an index fund, you own a small piece of every company in the index that the fund tracks. So, when those companies make a profit and decide to distribute dividends, you get your share. These dividends can then be reinvested to purchase more shares of the index fund, thereby increasing your investment. Capital gains, on the other hand, come into play when the shares of the companies within the index increase in value. When the fund sells these shares for more than what it initially paid, it realizes a capital gain. This profit is then passed on to you, the investor, either through a distribution or by increasing the value of your shares. But here's where it gets really interesting: the power of compounding. This is where your dividends and capital gains are reinvested to purchase more shares. Over time, these additional shares also generate dividends and capital gains, which are then reinvested again. This cycle continues, creating a snowball effect that can lead to significant wealth growth over the long term. It's crucial, however, to remember that index funds are typically a long-term investment strategy. While they may not offer the thrill of picking individual stocks, their consistency and broad market exposure make them a solid choice for steady, long-term growth. So, it's not magic, but a well-structured investment strategy that makes index funds profitable. Let's recap what we've learned today about index funds. Index funds are a type of mutual fund with a portfolio constructed to match or track the components of a financial market index like the S&P 500. They are designed to provide broad market exposure, low operating expenses, and low portfolio turnover. Compared to other forms of investments, such as individual stocks or actively managed funds, index funds often have lower fees and are less risky due to their diversified nature. They are a popular choice amongst investors for their simplicity and reliability. Financial advisors often recommend index funds due to their steady returns and low risk. They are ideal for long-term investment strategies and for those who prefer a hands-off approach to investing. Remember, investing is not about getting rich quick, but about growing your wealth steadily over time. And index funds can be a great tool to help you achieve that goal.